So, once again, guys, welcome. And today we are going to learn about portfolio diversification. Portfolio diversification, we have heard these words so many times: allocation, diversification, investments, uh, asset classes, risk management. All of these words are meaningless if we don't know how to execute this, if we don't know different kinds of products which exist. Diversification means investing into different areas so that your risk is spread into different asset classes. It always um, people always say that don't put all your eggs in one basket, and that means that if that basket breaks, all the eggs will break together. So you keep your eggs in different baskets to make sure that if one basket goes down, the remaining eggs are protected. I think something is similar with your investments also. If you put all your money into one specific investment, which a lot of people do, I think that's why it's important to do a session on portfolio diversification, because there are a lot of people who track only one kind of market. It could be just Indian market or just the US market or just the European market, or sometimes it's the metals. They only trade in gold, not in oil, not in currencies, not in any other commodities. And I think somewhere this has impacted the mindset of the investors, where they feel that just because they have done this before, it will help them to um, focus on one product. Investments does not work like that. If you're not aware about a product, you need to find out information. So you must invest in real estate, you must invest in commodities, you must invest in stocks, you must invest in bonds, you must invest in all these asset classes which are able to provide you a return. And that's important. So many times if you see companies, a lot of companies, they don't stick to one business. I'm not going to take names, but let's say, for example, there's a certain ride sharing app which started with the ride sharing but now has moved on to digital payment, food delivery services, or household cleaning services, and so many of these things. Why? Because they want to diversify. What if the ride sharing segment becomes too competitive? There has to be a plan B, a plan C, a plan D. Diversification works like that. So we need to understand today whatever we're going to discuss, right, guys? We're going to discuss a few portfolios today, and we're going to understand how diversification works. I'm going to give you at least four or five different sets of instruments, and which you can look at. And whatever we are going to discuss today is going to be strictly for information purposes only. If you like to put anything on your live portfolios, if you like to implement anything in your portfolios, please make sure that you talk to your risk experts, talk to your consultants, because whatever I'm going to tell you, it's not something which is risk free. There's a considerate amount of risk which exists, and that is why we need to be careful of what we invest our money in and when we do. Now, starting with this idea, I had asked this question, that why do you actually invest? Because when you have a good enough reason to invest, you are serious about it. And when you're serious about it, then you are a little scared also. Fear is good when it comes to investments, because if you're not scared at all, and if you're not anxious at all, that means that you're overconfident and you will ignore a lot of signs which comes from the markets. So we have to be careful, we have to be aware that there is a possibility that things could go wrong. And stronger the purpose you have, so you want your money to make money, you want to achieve independence, you want to achieve self determination, you want to leave a legacy to your children or to other people, you want to support a cause which you believe in. Everything requires money, and I'm sure you have your own purpose, that why do you want to invest. But then these are major purposes why people would want to invest. And the reason is because it is so strong, if you want to leave a legacy to your children, there's a cause which you want to support at, which means it's important for you to make money out of your money. And for that, you must be a little bit of scared when you invest. And when I say scared, please do not take me in the wrong sense. It does not mean that not being confident, or it does not mean that you are loss averse. Being scared means that you're the kind of person who is willing to take a step back when it is needed and think logically and keep your ego aside when you're investing. There is no way, there's no place for ego in investments, because financial markets have the capacity to beat you down and beat your ego. It can. Today, Japanese index has fallen down 3%. After reaching a high of 40,600, it just went down to 37,000. And there were investors who were long before, and then the Japanese index just went down and they closed their positions. There are people who made money, there are people who lost. And this is how this financial markets work. So you need to keep your ego aside and seriously consider that diversification is important. Now, this is why it is important, and this is the investment risk pyramid which you form. You diversify as per your risks and reward. So you definitely have to diversify. There are a bunch of products which you can diversify in, but how much to put depends on your risk. If you're a person who is closer to your retirement, don't have any source of income, you're going to live with the money which you have saved for your retirement. More exposure should be towards fixed income products, something which gives you a fixed income, something which preserves your capital. A little exposure, very little exposure towards stocks. But the reason is that maybe those stocks are the ones which are giving you a dividend or a fixed income, and they're not very volatile stocks. But someone who's younger, 25-year-old, 30-year-old, 35-year-old, still have time for your retirement. You need to be more exposed towards stocks, because you can make more money in stocks as compared to bonds, which gives you only fixed income. If you lose money in those stocks, you still have your life to work on and recover that money. But you have to take that risk. Taking risk is not a taboo, but in our world, it is being stated that, do not take high risk. High risk means you can lose a lot of money. It's not the high risk, it's the uncalculated, mismanaged risk which becomes greed. And that is where you're not able to differentiate between whether you are gambling or whether you're investing. And that's the difference. A high risk, if not calculated, can be lethal, but a high risk which is calculated, uh, that is something which all of us take into consideration. If you are willing to book a loss, that okay, this is the risk which I have taken, and if this risk level is breached, I need to get out and cut off my losses and get out. That is the way to do it. But if you get stuck, I'm going to put everything which what I have, and I'm sure that this is going to move higher, I'm so sure in this stock. That's not how investment works. Unfortunately, a lot of people are stuck into this cycle where they continue to fuel and feed their ego with false news and false hopes, and think that they are doing the right thing by doing this. So please don't do that. Risk management comes with proper diversification. So this investment pyramid tells you that how you should start the foundation of your investment. First, you need to have money in your saving accounts in very short term uh, uh, money market funds, which gives you a fixed income. Basically, the idea is that you should have some money which is liquid. Liquid means that whenever you want, you can take it out and convert it into cash, right? That's what liquid means. So you need that much amount of money. Plus, one thing which has not been added over here is the introduction of an emergency fund. I think post pandemic, all of us realized that emergency fund is something which all of us need in case if we are locked um, in our rooms and are not able to get out. That pandemic risk now needs to be factored in, because if your monthly expense is 10,000 dirhams, you need to have at least 10 months or 11 months of expenses covered in case if you're locked in a room and not working outside, or if you lose a job. So that emergency fund definitely requires to be there, and that can be in the form of your savings, in the form of your liquid funds which you can invest into, and that makes the foundation of this pyramid. That's at the very bottom. Then once you have that, then you make a little more money, which you put into this fixed income bonds. And bonds are fixed income instruments. We are going to discuss a little more about bonds today. And they're going to give you a fixed interest, a fixed coupon, and you can um, put money into those fixed investments. And these are available, by the way, and these are much less riskier than stocks, because it kind of gives you a preservation of your capital, and at the same time it gives you a fixed income. And once you have put money into that, then the remaining money you put into blue chip stocks, you put into mutual funds, you put into real estate, something which um, uh, it's always recommended, because this hedges your inflation, right? You might receive fixed income on bonds, but that fixed income will mean nothing if inflation is increasing. All you're receiving is fixed 5-6%. If inflation is reaching to 8-10%, what are you going to do? So you need to put money into stocks, you need to put money into blue chip companies, real estate companies, and that's how it works. And then at the tip of this pyramid, which is at the top, once you have these three parts sorted, then you go to the top and start speculating in gold and oil and take advantage of these short-term trading opportunities. As you see, the arrow which is from downward to upward, it shows that from the bottom of the top till the top, your risk increases, but your rewards also increase. The money which is lying in the bank or in a savings account, the return in that is minimal, but the risk is also minimal. As you move a step higher, the fixed income bonds, the corporate bonds, the municipal bonds will give you slightly higher interest than your bank account or their fixed deposits. Then you move a little bit, invest into real estate and stocks. They're going to give you a significantly higher return than bonds. And then you move on to the speculative commodities and currencies and indices, and that is something which is capable of giving even higher returns. But with that higher return comes a higher risk also. And that's where we need to understand that why diversification is important, because some of these products are less risky, less return, but some of them are high risk, high return, and we need a tweak of that. And that tweak depends on various factors. So we're going to understand uh, uh, a lot about how we can do these tweaks. Just to give you a small idea about, let's say, in terms of your salaries. For example, if you're making around 5 to 10,000 dirhams per month, uh, you need to have an emergency fund. You need to have savings account. You can invest into national bonds, sell salary savings plan, short-term U.S. Treasury bills, which are one-year bonds, which gives you fixed income, right? You save a lot. Then you move a little bit more from 10,000 to 20,000. You start putting into fixed deposits, corporate bonds, mutual funds, right? ETFs, for example, but mostly funds. You still are not speculating, because your salary is 10 to 20,000 dirhams per month. 20 to 30,000 dirhams per month, you can start investing in real estate, start saving for investments in real estate, in stock markets. You can also trade into cryptos or other instruments. But then again, cryptocurrencies is only because now this asset class exists. So I'm telling you, but obviously I would not suggest your hard-earned money to be put into cryptos, because they're not regulated and they're very risky. But you can always try to look at alternative investments, right, apart from your traditional. And then 30 to 40,000 dirhams, anybody who's making definitely should try to invest into some retirement funds as well. And then you can directly invest in stocks rather than using mutual funds. You can buy and sell stocks, and you can also trade in indices, and you can do a whole lot of speculation. Of course, a salary more than that will definitely allow you to tweak this composition. But then, as you can see, with a lower salary amount, you don't take a very high risk. When I say lower salary amount, I'm just giving you a lower slab. It doesn't mean 5 to 10,000 dirhams is less, but the whole point is, as per the current inflation and the risk factor, it's important that we divide our salary into these slabs and only invest as per our capacity. So this is one way how you diversify on the basis of your income. Now, how you diversify on the basis of the asset classes. There are so many asset classes which are available, and a lot of these asset classes, they exist, I'm sure, more than uh, so many products which you see from banks and asset managers. And a lot of these products, they are made out of these asset classes, right? So whether it's a bond or a structured product or a fund, all of that will have a lot of these kind of instruments. So these are called asset classes. Asset class, they share common attributes. So if I say gold, silver, copper, crude oil, they're all natural resources, rice, wheat, sugar, all of that um, makes the one asset class which is called commodity. You talk about euro, pound, yen, dollar, all of these are currencies, so they make one asset class which is called forex. Then you talk about Apple, Google, Facebook, Tesla, all of you can invest into these companies by the medium of stocks, and that is why they are one asset class. And then there is real estate, there's bonds, there are funds, mutual funds which are made, which can be in the form of share baskets also. Really quickly, when we talk about stocks, we're talking about these individual companies you can invest in. When you buy shares, you can be a part owner in the company. So if you want to invest in Amazon shares, all you need to do is look at the Amazon share price. One share is equal to $150, for example. Just give an example. So if one share is equal to $150, you can buy 10 shares, it will be 1,500. So you're able to invest the money into the company. And if Amazon works well, they show good financial results, they introduce good products better than their competition, then the value of their share increases, and with that, the value of your share increases, and you make money. And that's how stocks work. Every single thing you can think about or you're using right now, majority of them have stocks, or majority of them allow you to invest. From ordering from Amazon to driving a BMW or a Mercedes or a Toyota or a Volkswagen or Tesla or Honda for that matter, to wearing Adidas or Nike or Skechers or eating McDonald's or KFC or drinking coffee at Starbucks, um, or using a MasterCard or a Visa, having a Netflix account, using Facebook or Instagram, a lot of this you're already doing. And even using an iPhone or using a Microsoft Excel or a PowerPoint or having a Zoom call, all of you have used these products, but have you invested in these companies is my question. And that's why it's really important to have that information, that while you're buying iPhone 16, that iPhone 16 in the next 4 years is not going to be relevant. There will be other iPhones, just like iPhone 11 is not relevant anymore. iPhone 12, 13 is not relevant anymore because now 16 is there. Soon 16 will not be relevant. 20 will be there, or 21 will be there. Who knows? But Apple stock, if you buy and hold on to it, it's going to be really relevant, given that everything goes well with the company. So that's why you invest and you diversify. I think that is something which is really important. A lot of people they they are they don't look at this that way, but then I hope that you understand what I'm trying to say, that while we continue to use these products, we also need to understand that these products are from companies which we can invest in, and we can invest in it very easily using an online platform, and you can just put as small as $100 in it, and that will still count as an investment, right? So you can do that, you can save some money and you can invest, and that's the idea. So that is one asset class. Next asset class is commodities. Over the past few years, we have seen that how commodities have continued to give a different market perspective. Sometimes when investors, they get scared, they don't know where to invest in stocks or bonds, they look for commodities like gold, which act as a safe haven. Since 2024 till now, gold prices have moved up by almost 30-35%. And let alone this month, gold prices are already up around 5 to 6%. So commodities are important asset class. You can invest into commodities. It is definitely expected that you can invest into commodities directly, but you can also invest into commodities through funds. or through other companies. Like, for example, if you are more interested in gold and you feel that gold prices are going to go higher, you can always invest into gold mining companies or gold mining stocks. But then obviously you will be diversifying in terms of industries, but in terms of asset classes, you are still invested into stocks. So sometimes investing directly in commodities like gold, silver, or in agricultural commodities, so many times when markets could be going down, but cotton, which is grown in um, humid weathers, is facing a shortage of supply because it's the month of December, and all of a sudden cotton prices start moving higher. So commodities can again give you a very, very important tool for diversification, and that's why it's really important that you must have a look at it. So these are the kind of commodities which you can look, followed by currencies. Currencies are the largest market. I mean, $6.6 trillion worth of daily volume trading, and I think currencies move a lot on the decisions of central banks. Now, my last 15 years, what I've observed is that currency is not a very long-term trading instrument, because um, currencies get their volatility from literally everything you can think: industrial production, housing, construction permits, non-farm payrolls, jobs report, unemployment rate, inflation, deflation, money being injected, wars, elections. Every single thing affects the currency of that country. So it might be the most volatile asset. So you may not want to invest in the currencies for a long term. But for day trades, a lot of traders, they use currencies for day trading. And I think if you're looking for short term opportunities, this could be one of those areas. But always put a stop loss and do not take a very high leverage when you are day trading. And that's where it could become dangerous. Just to give you an example, dollar yen itself today has fallen down more than 1% on the news that Japan is going to do more tightening of the policy. And on this particular news, dollar has become weaker, yen has become stronger, and dollar has gone weaker against yen by 1.5%. And that does not usually happen in a day. This is, I'm talking about, in one day. So it's a possibility. Currencies are really volatile, and it could be a good tool for day traders, but for long term investors, I would suggest it's not always a good idea, uh, unless a currency like euro or pound has fallen down to record levels, and you're expecting that this is going to, I mean, it's still going to be an individual risk, but then you need to be very careful when you're doing that. Then you can invest into these different themes through a bunch of stocks put together in one basket. So how many of you think about, I should invest into AI or robotics or space exploration or renewables or gaming sector, and you want to be specific to those sectors. So instead of picking out individual companies which might fail, you pick the whole basket. And when you pick that whole basket, there are a bunch of companies put together in that basket which are relatable to that theme. And the way these baskets perform, the way these companies perform, the basket moves accordingly. So you invest into this also. And then, so you're looking at these different asset classes, right? How many ways you can invest? Talking about stocks, then funds, then commodities, then currencies, and bonds. Bonds are fixed income instrument. uh, Bond is more of a debt based instrument, which basically means that if you are a sort of person who likes to have a fixed income, you can give a loan to someone and they will pay you the interest, and they will promise that they will pay you your money back after a stipulated time of period, just like banks do to you when you take a loan, that they tell you to pay their money after a stipulated period of time, let's say in 4 or 5 years. Until then, you continue to pay interest. You can do that, and you can do that yourself, and you can become a bank, or you can become a lender. But this time you will be the lender to US government. So US government issue bonds, so they become the bond issuer, and they allow you to buy these bonds. And by allowing you to buy these bonds, they're actually borrowing money from you. And in the bond they write that this money you can, the maturity of this bond will happen in the next 4 years, so you will get your money back in 4 years. Until the time we are using your money, we are going to pay you a fixed interest, which is called coupon, by the end of the year. And that coupon currently ranges from 4.5 to 5 to 6%, depending on how the central bank interest rates go. So there are governments which issue bonds, there are companies which issue bonds. You can invest into bonds and corporate bonds, government bonds separately, and that's also a good way to diversify. So now you can see how many ways are there? How many asset classes exist to invest in? Within commodities, there are metals, there are energies, there are agricultural commodities which you can diversify in. So there is inter commodity, there is intra commodity, and then there is within these asset classes, there are so many instruments which you can invest into, right? So now, how do you actually allocate these asset classes in your portfolio? Would you be buying more bonds than stocks, or would you be buying more commodities than bonds, or would you just do mostly short-term trading? How do you determine that? So that depends on your age, right? There are so many concepts about that, but it's very important. If you are a younger person, then you know that you have your rest of your life to earn more money. So you need to go for higher risks. And when I say higher risk, does not mean close both eyes, dive in head first. No. Whenever I say that you can go for higher risk, I mean to say you can go for riskier assets. You can invest more into commodities, you can invest more into stocks, invest less into bonds. You employ more capital towards the areas where the capital growth is expected. Rather than a fixed income, you should seek capital growth, and that is where the age factor comes into play. If you are older, closer to your retirement, you are 60, 65, 70, or you are not expecting any source of income, at that point of time it makes more sense to be more inclined towards something which gives you a fixed income and promises to pay your capital back. So bonds are one of those areas which can preserve your capital and give you a fixed income. I don't think it's going to be wise to trade during that time, because trading can involve a huge risk, and if you're not careful, you lose your capital as well. So age is one of those factors. Time horizon. I mean, if you need your this money back real quick in the 3 months or 6 months, then a fixed income product makes more sense. Um, if you're saving this money for your child's education, then you can invest into an SIP, which could be based on an index, or you could invest into bonds, which will get mature after 10 years or 15 years, and which will be the exact date when your kid starts going to college. But you definitely not trade with that money. You definitely not put that money into cryptocurrency. So that's where the diversification becomes really important as per the time horizon. And what's your financial goal? Sometimes when people get retired, they want to build up a restaurant, they want to live their life, they want to travel the whole world. So how much um, spending is going to be? So when you're right now investing, are you investing with that mindset that the kind of returns I need is that even when I'm retired, I can still live a lifestyle which I want to? So your financial goals are really important when you're investing. Number of dependents on your family. How many people are dependent on you? If so, obviously more dependents, less source of income. You need to be more um, uh, towards the idea of fixed income rather than going too crazy on growth. But if there are less dependents, or if you're not married or you don't have a child, then you can still go for higher or riskier assets. Now, moving on to the risk profile again, a lot of us have chosen our risk profiles on our own. Like, how many of you feel that you have a high risk taking capacity? Sometimes you sit and you watch these movies and you feel, what, I should definitely be able to take that risk, because without risk there is no reward. What's the life without a little high risk? I think that kind of mentality suits to the investors who are capable of taking that risk. But we should not generalize, and we should not idealize taking a high risk. And we should understand that maybe the heat of the moment, or the factors around us, are telling us that, what, it's so good to take that risk. But inside, we may not be the most aggressive risk takers. So all of us have our risk profiles, and those risk profiles are based on our attitude towards investments, our attitude in general, our circumstances, and the kind of income we make, the kind of money we make, and all of that. So you need to have a clarity on your risk profile, and just do not get into a herd mentality. Don't listen to others when it comes to your risk profile. Your risk profile needs to be decided by you. If you don't have that capacity to see red in your portfolio, then that's it. Then you're going to go more inclined towards fixed income, less towards stocks. And that is something which is important, and that's what you need to see. And then comes the income stability part. Now, income stability, of course, if you are a part-time jobber or you have work which is more and more full-time, and it's something which you expect to continue years over years, you are right there, you are making good money, and you feel that your salary is fixed, and you can do that. So income stability is very important, and if your income is not stable, then obviously your inclination towards fixed income and other asset classes would be less. See, irrespective, um, I would always suggest a diversification. I mean, I would never tell you to be stuck to one asset class. It's just the composition, that if your income is not stable, then maybe you should be more inclined towards the fixed income, less towards the stocks, or more towards the stocks which are giving you a fixed dividend, less towards the tech companies which are really volatile. So you need to understand that part. Talking about that, so there are different ways to diversify. One of them is SIP, or we call it as systematic investment plan. So way of investing in mutual funds where investor can invest a fixed amount. So just to give you an idea, even if you are able to save $100 per month, you can actually start investing that $100 per month. But you bring that discipline into your investment, that every month I'm going to invest this $100 a month into this particular index, and it does not matter whether the markets are going up or down. I've seen so many people, sometimes they are doing these wonderful systematic plans, they are buying every month, they have a dedicated amount. The moment market starts going down, they get so scared and so skeptical. They feel, no, that's not the right time, I want to save my money, why should I invest into something which is going down? Please understand this. This is called dollar cost averaging. When markets are in fact going down, you should invest more. And I'm talking about the stock indices, not about a commodity or currency, especially stock indices, because in the last few sessions, I'm sure if you have attended, we did an analysis where we saw the power of being fully invested all the time, and we saw that how important it is that if from a certain period of time, from say 1940 to 2024, if you were invested wholly into the S&P 500 index, you would make an X amount of return. But if you were not invested for 10 best days when S&P 500 moved, if you missed out on those 10 best days of trading in 30 years, your returns would be cut into half. So we saw data of 30 years, and we realized that in those 30 years, if you missed out on 30 best trading days of S&P 500, your return would be somewhere low as 50%, as compared to if you were fully invested throughout these 30 years. So do not miss out on the power of bearish markets. The majority of the time, investors earn a lot of money is during the bearish markets, not during the bullish markets. So you need to be careful. When you see a bearish market is coming, you have to make your mindset that with every 5 or 10% dip, I'm going to buy more, because eventually when stocks move higher, you are the one who come out as victorious. So do not get uh, do not get too anxious. Fear is good for the markets, but that is only to make you less arrogant. But that fear should not make you coward. You still need to invest. So when markets are going down, and again, it's important you talk to your risk experts, talk to the consultants. Everyone needs a consultant. I mean, you may not need a fund manager, but you need a consultant. Consultant is just to give you an opinion. And sometimes we feel that, how many times you feel that you're not well, and you don't need to see a doctor, or when you go and see a doctor, you do not follow what he says. and you just feel that it's just going to go on its own unless it becomes more worse. And then you go to the doctor and you're like, okay, I'm ready to do whatever it takes just to get out of this. Consultants, investment consultants, are like doctors. You may think that you don't want them, but you really need them. And that's not because they are better and you're not. It's just because markets are unpredictable and you need a second opinion. Everyone needs a second opinion. Always remember this. You always need a second opinion. When you take a decision, having a second opinion does not makes you weak. It just makes you more cautious. It just makes you more careful. So when you're investing, you definitely need a consultant and take their opinion and do whatever you want, but definitely take an opinion. And I think I have always done that. And I've been in this market for 15 years, and I still, if I have to invest somewhere, I will talk to people. I will take a consultation before doing it, because it's not about how much I know. It's about things which I don't know, and there is so much we don't know. And something which we don't know, we will never be able to find out the rights and the wrongs in it. So we need to find people who are aware of these things, and we need to make the best out of it. Now, moving on, as I said, the SIPs, they removes the need to time the market. So as I said, a lot of times investors say that it's not the right time. I'm telling you, the right time to invest is right now. Right now, you should invest. Right now. Right now is the only time which you should invest. Because if you are saying that no, right now markets are going down, I will invest when it starts moving higher, which means when it's going to go up. Or when you say no, markets have already gone up, now it's the time it's going to come down and then I'll buy, which means that when it's going to go up or down. And we all know that you or me, none of us knows that when it's going to happen. So stick with your SIPs. That's one of the best investments you can have. Of course, SIP brings the benefits from the power of compounding over the longer term. Imagine, like, if you have a child and you're saving for their college money for another 18-20 years, do an SIP for that period of time. I'm not talking about trading. I'm talking about putting a systematic system into the place where every month a dedicated amount you buy an index fund with, and that's only going to help you to build up that portfolio, which in the next 15-20 years is going to bring hopefully much better returns. And again, if you do it here in UAE, obviously there are no taxes for UAE residents, so that's one of the bigger advantages when you're doing it from India or any other country which is putting you liable for the short-term or the long-term capital gain taxes. So that is one of the advantages you can get. Now, when we are doing risk management, when we are diversifying, we need to do some sector-based diversification. Economy does not go in a straight line. It's not always booming. It's not always recession. It moves in a curve. And it starts with an acceleration, then it reaches to a peak, and then it starts decelerating, and then goes into recession, and then recovers from the recession. So there are times when the acceleration is going on, you are investing into luxury products, you're investing into financials, industrials, IT, real estate, because that's the time when economy is booming. And then a time comes when it starts peaking, which means now it's positive, but the growth is very moderate. So invest into communication sectors, IT sectors, you start getting rid of consumer discretionary or luxury companies. And then when you see the overall growth rate has slowed down, I'm not talking about a falling growth. I'm saying that the growth rate has slowed down. It's not growing at the same pace it used to be. So there is some sort of deceleration. So you start investing into defensive companies, yeah, you consumer staples, consumer utility, coal power, healthcare kind of companies, right? Energy based companies. And then if the growth contracts, you're into recession, you definitely be stuck to utilities and healthcare, because these are the companies which will always be in business, right? So this is how economy moves, and within these industries there are so many companies, and within those companies so many balance sheets to look at. That is why you require a consultant who can do that research for you. Now, if you are a sort of investor who need a defensive strategy, so you are probably in a slowing economy, right? So let's say your economy is slowing, and your goal is to reduce the volatility, reduce the risk. So what to do? You invest into a sector which basically outperforms the market when the economy is slowing, is lower volatile, it's not that volatile. And those sectors are utility, healthcare, and consumer staples. Consumer staples are food stuff and food beverages which you need on daily basis. So this is your defensive strategy. But if the economy is growing and you're anticipating that the economy is expected to grow, so you're looking at an opportunistic strategy. So, which basically your goal is to enhance the returns. So, you invest into a sector which has high volatility because that can bring increased capital. So, this is opportunistic strategy. Moving to preemptive, where you expect rising inflation, which was in 2022. So, to protect your buying power, you will invest into those companies which basically moves higher, which are able to absorb the cost of inflation, and that their prices are tied to the price of raw materials or the real estate. So these kind of sectors definitely help you to hedge inflation, to protect your portfolio from inflation. And I think that is one way how you can manage your risk and do sector investing. Now, guys, we are moving very fast towards a transformation where semiconductors are going to be a very core component. So this is just to give you an idea that how industries move and why diversification is important. Because at this point of time, semiconductors would be responsible for literally everything we can think of, whether it is about AI, machine learning, future of work, cybersecurity, 5G, self-driving, fintech, digital payments, customer engagement, or cloud or software as a service, Salesforce, CRM, all of this, or e-commerce or new commerce, every single thing. Semiconductors are going to be the center of everything. So um, I'm sure there are ways that you can invest into semiconductors as well and diversify in that area. We should not be ignorant to change. Please remember this. A lot of investors traditionally they have not focused on sustainable part. Sustainable investments, which is different from the semiconductors. While we're talking about semiconductors, let me bring in attention that why sustainability of your investment is really important. At this point of time, we continue to use fossils a lot, and there are a lot of researches being done, and if sea levels rise any further, you will see that probably the government might have to switch from fossils to renewables at all. And at that point of time, what happens to these companies which are based out of fuels, your coal power companies, where most of the pensioner funds are put in? So you need to think about that. You need to diversify. Don't put all your money in utilities. Put your money into utility, um, but put your money into sustainable funds also. Put your money into renewables as well. That is where the diversification is really, really important. Right? I'm going to give you a portfolio, and I'm going to show you different portfolios actually. And let me start with a few different portfolios. You can try to mix and make a basket for yourself. But obviously, as I said, that do talk to your consultant first before you do that. Now, I'm going to show you the first one, which is a very recent one, and there are two of them which I want to show you very recent, and then two of them which we have made a little ago. But let me just show you one here. And please, till then, if you have any questions, do continue to write questions. We are definitely there to give you an answer. And if you have any questions regarding your portfolios, you can definitely share that and definitely ask. I'm just putting this here so I can share this with you guys. We did a session on US elections, and I think during that time also I fairly discussed about where you could invest. But then since we are talking about the diversification, even in investments and in events, we need to understand that diversification is really, really important. And there are so many events happening in US elections being one of them, and we need to be careful about how this is going to shape up. And it could go anywhere, right? So we need to be more careful that how do we diversify there, and that's why we need to know all kinds of investments which we have. So I'm going to share the screen right now with you, and let me know if you can see this properly. First, let's go to something which has been the talk recently. I'm sure, I don't know how many of you have done this, but you must have heard about how Coldplay tickets have been on sale, but people have not been able to buy. Some of them have bought, some of them are selling at a very higher price. Now, obviously, you may not have got the Coldplay tickets. If you have, please let me know. I'm looking for one. But let's say if you have not, then if you can't celebrate or go to the arena, at least you can look at these stocks which can get benefited by the event. So the tickets for Coldplay concert in Abu Dhabi to be held at Zayed Sports City, capacity 43,000, sold out in minutes. Due to overwhelming response, again, a second show has been added on January 12th. And today, as I'm telling you, there's one more show being added on January 14th as well. 3 or 4 shows, I think. One of the most celebrated music bands of all time. Two of the 15 highest grossing tours of all time. And again, Abu Dhabi concert is a part of the Music of the Spheres World Tour, which is 2025. Now, a high demand for tickets reflect the strong fundamentals of the live concert sporting events industry. This business is now booming after the end of the pandemic, and this sector has a huge potential due to the growing demand in live entertainment. Higher ticket demand has led to ticket price inflation. Additionally, there are now diverse revenue streams such as sponsorships, merchandise, food, beverage sales. So even when a concert happens, you see a lot of these businesses also flourish. So UAE event is going to be sponsored by Etihad Airways and Abu Dhabi Tourism, and that is the reason why if you see these stocks, companies like Live Nation Entertainment, which produces live concerts and sells tickets to those events over the internet, and this is basically a recreational service sector. Potential share appreciation, as per the Bloomberg analyst, is around 9.8%. And Atlanta Braves Holdings, which basically owns the Major League Baseball club, and it is associated with development projects. Again, it's recreational services. The potential share appreciation price by Bloomberg analysts is 38%. Then there's Madison Square Garden Entertainment and Eventbrite. Madison Square owns and operates entertainment venues, and host live events such as concerts, family shows, professional boxing, basketball, martial arts, and all of that. And the potential share price appreciation is expected to be around 13.5%. Now, if you look at Eventbrite, it's an international ticketing platform. 27, if you see here, market cap in billions, it's very less. But if you look at their prices, also $2.8 is the price, and the potential price share appreciation is 81%, and that's huge, right? So we are looking at these companies. There's a fair description given about all these companies, and if you want this portfolio, just contact your relationship managers, and we'll be able to provide you that. There's a detailed fundamental analysis done on every single stock, and you can have a look at it, you can read at it. And just to give you an example, as you see, regarding Madison Square Garden Entertainment, in September 2024, this company has formed a strategic partnership with global tech brands Lenovo and Motorola Mobility. And they're marketing the products of Lenovo and Motorola through commercials on MSG networks, featured ads across VIP sitting areas and arena center hugging, and a lot of this, right? So a lot of fundamentals being covered into this report, and it helps you diversify in one manner, right? So this is one area which you can look into. I'm going to show you one more portfolio here before we move on to another. Look at this right here. I think we have had, I think, session last week regarding US elections. And we have been talking that which area would get benefited if Trump wins or Kamala Harris wins. And look at this portfolio right now, just to give you an idea in terms of diversification. See, US voters will head to election booths on November 5th to choose the next president for what could be a bumpy 4-year presidency. To secure the presidency, candidates must obtain a majority of 270 out of 538 votes. Now, let's understand the strategic recommendations. In Trump's presidency, you buy a basket where you can diversify Lockheed Martin, Caterpillar, Chevron, Simon Property Group, Short, First Solar, CVS Health, Tencent, PDD, which is the parent company for Temu and Shein. And so if Trump becomes the president, obviously more focused towards defensive areas, arms and ammunitions like Lockheed Martin, towards real estate companies, or which can get benefited, Simon Property Group or Caterpillar, and then energy-based companies, because Trump wants more uses of fossils. So Chevron could get benefited. But then the companies which may not get benefited, renewables like First Solar, healthcare-based companies like CVS Health, Chinese companies like Tencent or PDD, for example, expected not to perform well because Trump's relationship with China has always been a bit sour, and that is the reason. In case of Kamala Harris, again, companies like First Solar, CVS Health, Nvidia, Rivian expected to do really well because Democrats, they promote the use of renewables over fossils. So I think that is one of those cases. Shorting the baskets of energy-based companies, Altria, Core Civic, again, and then Smith and Wesson. And these kind of companies, again, guys, if you see the current probability, so look at these companies when you're talking about Altria Group or Smith and Wesson brands. We are expecting these companies to fall, and again, there is a proper rationalization given that why these stocks are expected to do better. Especially the small cap companies will likely to do well as they have historically performed well under Republicans more. Tax policies for Trump are going to benefit those companies which have like a very high tax rates. Real estate stocks are expected to do better because Trump has a background in real estate, so he maybe try to implement policies which are more favorable to that sector, right? So again, there's a proper explanation given to all of them, and as I said, this is for today. It's 27th September. This has been something which has been prepared right away and has been sent to me to discuss with you guys. So you can definitely get a copy of this from your relationship managers, and they will be able to help you out and just give you one of these handouts also. You can have a look at it. So that being said, I'm going to share one more diversified portfolio since we are talking about it, how we can. So we talked about US elections, how we can diversify among different sectors. We looked at the Coldplay saga, how we can look into a completely different area of concerts and advertisements and how we can get benefited out of that. And let's look at a further diversified portfolio which can help you to plan your investments. There is one for SIPs and one for different stocks. So this one is for SIPs. You can do an SIP with starting with $100 or $500 or $1,000 a month, and you can divide those money into these 4 different funds. Now the first one is Invesco Triple Q Trust Series, which gives you an exposure in tech companies of US or Nasdaq index. But this is a ETF, so you can invest into, you can buy and hold on to it, do it without leverage, so you don't have to pay any holding cost. And this is the fund which you can invest in, gives you a exposure in tech companies. Second is SPDR S&P 500 ETF, and this is the one which is I'm just going to show you as well. At least the holdings is something which I can quickly show you over the chart. So this is right now Invesco Triple Q Trust Series. Look at the holdings, guys: Microsoft, Apple, Nvidia, Amazon, Broadcom, Meta, Tesla, Alphabet, and higher weightage. By the way, if you do the industry analysis of this particular fund, within tech, higher weightage is given to semiconductors, internet, software, computers, and then retail, and then biotech. So majority of this fund is dedicated towards semiconductor-based companies, internet and software companies, and it's mostly US, what you're looking at. And then SPDR S&P 500, you can diversify completely. Again, the major holdings are Microsoft, Apple, and Nvidia. But then if you see, the industry is more diversified. You're looking at internet, semiconductors, softwares, but there is pharmaceuticals also, there is insurance also, there is banks also, there is healthcare also. Again, a lot of diversification amongst the industries, but still it is based in US. And then you move from country and you go to India 50 ETF. So here the top holdings are HDFC, Reliance, ICICI, Infosys, Larsen and Toubro, Bharti Airtel, Axis, State Bank of India, and more emphasis towards Indian banks and oil and gas and computer companies. So this is more focused on India. So you can buy that fund. And then there is the SPDR gold shares, which are mostly into gold as a commodity. Their proper holding is the gold as a commodity. So you can invest into a fund which is holding gold. And followed by TLT, which is also called iShares 20 plus year Treasury Bond ETF. It's an ETF which tracks the performance of long-term US government bonds, and it is investing in bonds with a maturity of more than 20 years. So currently in a rate cut cycle, US is in. I think this could be one of those more beneficial products because there are a lot of macroeconomic factors, and right now the fund's market price is down around 8 to 9%, and that means it's a very liquid fund, and most of the performance is tracked for the long-term US government bonds. And if the rate cut continues to happen, the prices of these bonds might increase, and the price of this ETF might also increase. So that is again one of the ways you can diversify. So if you see what we did here, we put into Nasdaq tech, which we put into S&P, which is banks, retails, insurance, And then we put into bond-based funds, which is completely fixed income. Then we put into SPDR Gold ETF, which is completely commodity. Then we put into India-based funds, India 50, diversifying in different areas, and that's something which is really important. Now, before I leave, real quick, let me show you an SIP's portfolio as well, so you can have a good look at it. And I think it's really important to understand the value of SIPs, because sometimes we might neglect it, but you can actually do. Sorry, the one which I showed you was an SIP portfolio. You can do SIPs, but this is more of a diversified portfolio, and you can look into these companies, right? So in a diversified portfolio, what you're looking at is different kinds of companies. Now, some of them are dividend stocks: Comcast, Procter& and Gamble, Coca-Cola, Essential Utilities, Frontline PLC. And then there are tech stocks. You see what we did here? We diversified between the companies which gives you fixed income, less volatility, like Comcast, P&G, Coca-Cola, etc. And then we give you those stocks which do not give you any fixed income, but they are very volatile. They move a lot. So that increases your capital. One gives you fixed income and less volatility. Once one section increases your volatility, does not give you a fixed income. So capital growth chances here, fixed income chances here. And these growth stocks are Nvidia, Amazon, CrowdStrike, Microsoft, Alphabet, mostly the tech companies which you are looking at, right? So, guys, that's the idea for diversification. I think I've shared at least 2 or 3 different portfolios. There is a whole fixed coupon bonds portfolio which you can have a look at. As I said, the rate cuts are expected to continue, so you can look at corporate bonds, fixed income bonds, and they are going to give you a fixed coupon. So the price of these bonds can go higher if the rate comes down, because in the market the rates will be less, but these fixed coupon bonds will still give you the fixed coupon, so their prices might appreciate. So you can diversify in the bonds market here also. And I think that's the most important part, because now you're able to diversify between stocks, between bonds, between commodity funds, between what's going to happen in elections, between um, what happens to the Coldplay concert. You can get into these different companies which are into concerts, which are into entertainment or advertising or ticketing, for example. So a lot of ways are there to diversify, and I think you should be open to the idea of diversification. You should be open to the idea of spreading your risk in different directions. That being said, we reach to the end of this session. Now, normally, when we are ending the session, we tell you that there is going to be a series of more webinars. So, but since this month is about to end, I have one more webinar left, and it is going to be on Monday, and it's going to be about the corporate earnings, the earnings season, because earnings season will start in October, where most of the companies are going to disclose their financials. And a lot of these companies, you already know, they're going to share their financials, and you can learn a lot by attending that session, that how to trade in earnings. And that is going to be the last session for this month before we do any further sessions. So once again, if you like the portfolios today, you can go to your relationship managers and ask them for a copy, and they will definitely send you one. But please talk to the risk experts before you execute any trades in your live account. And if you like this session, please go on Google review Century Financial. Let us know how you feel and how you like the session, and we'll make sure to work to make this more and more better, and make sure that we bring more and more sessions like this. It really helps us and encourages us to bring more and more sessions, and keep us motivated to work more towards financial awareness for our people. So thank you so much for joining. I'll see you on Monday. You have a safe weekend. 7 to 8 p.m. Monday, again, we are going to meet on different topic. And it was a pleasure to host this for the entire month. And I think as this month comes to an end, as the session comes to an end, and on Monday it's going to be more of a finale, where we are going to just do a big brush through of what we have discussed over these last 1 month. And let's try to make this a habit. We have done 20 sessions, and 21st is going to be on Monday. So 21 days of trading, 21 days of sessions, and it takes 21 days to form a habit. And I hope that by now, a lot of these names which I have seen earlier, and plus the new ones, now they're forming a habit of learning more and more about financial concepts and understanding how the portfolio should be diversified, and and how you can use different strategies during different times. So thank you so much once again. You have a good night. Trade safe, be safe, and you have a great weekend ahead. And my name is Yogesh. I'll see you Monday, 7 to 8 p.m. Thank you so much.